Hi, this is Eric Dunavant with Dunavant Wealth Group, the Dunavant Wealth Report for February 2012. Let's take a look back at the start of the year. January was a quiet month as far as the markets were concerned, and I think that we'll all take that considering everything that we went through in the last year. All 4 weeks of trading in the markets ended positive, and the S&P 500 looks like it's going to finish the month up about 4.5%. Now, the S&P 500 is an unmanaged index which cannot be invested directly into, but we do use that as a benchmark. From an economic standpoint, the last month has kind of continued where we see just a muddle through of the economy. Jobless claims remain below 400,000, which is positive, and unemployment came in about 8.5%. But unfortunately, the jobs that we're creating are barely keeping up with population growth, and that's not going to allow us to reduce our unemployment much further at that rate. Fourth quarter GDP came in at about 2.8%. It's kind of a good news, bad news story, but the big concern that we'll have to watch throughout the year is whether or not that number was grown off of inventories being replaced in some businesses. And lastly, new home sales came in a little bit worse than expected. So again, like I said, kind of a muddle through. On the news and noise this month, you're going to hear a lot of noise about how over the last 30 years, long-term government bonds have outperformed the S&P 500, although not by much. But the interesting thing is that the last time that happened was during the Civil War. So what happened? Well, as you may or may not know, bonds work like a seesaw. When interest rates go up, the value of bonds go down, and when interest rates go down, the value of bonds goes up. Well, where were we 30 years ago? Well, 30 years ago, long-term treasuries, 30-year bond, were about 15+%. And today, they're at about 3%. So over the last 30 years, what we've had is a decline in interest rates, which have allowed bonds to go up. Why do I bring it up? Well, the main reason is that it's important that you don't try and predict what's going to happen over the next 30 years based on what happened over the last 30 years. There were certain factors in place that allowed that to happen, and the odds are against that happening again. So just make sure that the noise doesn't distract you from your long-term plan. In this month's True Wealth tip, I'd encourage you to take the time and go check your credit report. You need to do that at least once a year. Now, it is free to check, but you have to be careful because there's a lot of good companies out there who try and trick you into going to their website and want you to sign up for a service. There's only one place you can go to check your credit report for free once a year, and that is annualcreditreport.com. There you can check all 3 of your credit reports. Why do you need to do so? Well, it's been estimated that 75% of all credit reports have an error of some kind. It also is a way that you could help identify identity theft or possible fraud that's happening. Again, you should check your credit report at least once a year, and annualcreditreport.com is the one place that it's free. As always at Dunavant Wealth Group, we would appreciate your prayer requests. If there's anything at all that we can pray for you about, we take time to pray every day and be honored to partner with you in doing that. At Dunavant Wealth Group, securities are offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Dunavant Wealth Group, a division of Cardia Planning, LLC, and a registered investment advisor, and an independent entity from LPL Financial. Thank you so much for joining us this month. We look forward to seeing you with us again next month. Take care.